Morning, Stuart.
Morning, James.
I don't know how old that photo is, but the one I found on the internet.
The pre-COVID one.
So we're going to talk about Alliance Trust. I think, as per usual, we'll just get you to kind of introduce it first, please. I mean, I think it's a fund that people know quite well, but nevertheless, it doesn't hurt to sort of have a recap, please.
Yeah, sure. I'll just do a couple of slides then on just reminding who we are and what we do, a little bit about market context and how we've been doing recently, and then hopefully we'll have plenty of time for discussion. So, as you say, I think long-time followers or listeners will know Alliance Trust appointed Willis Towers Watson as investment manager back in 2017. So, when we started managing the trust, we brought this new strategy to managing global equity portfolios. The thinking behind it was, Alliance Trust has got clearly a very long heritage, as people know, and it has this very long-term sort of investing for generations mindset. So, the duration and long-termism is really inbuilt into Alliance Trust. But at the same time, we know that investors have got a lot of options when it comes to global equities, and we wanted to do something different. And frankly, something that we think is a better way of running global equities, trying to do things differently from other people. So how we do that is really shown on the pillars on this slide, really. So we start off with very high conviction portfolios. I think people know it's a multi-manager structure, but we don't just invest in managers' funds off the shelf. We actually customize mandates for Alliance Trust that concentrate on the manager's very best ideas. So we only allow them to hold up to 20 stocks. This is because the skill set we think they have is picking companies. So we want their best company ideas. We don't want their 50th or their 100th best idea. We just want to focus on the highest conviction companies or highest conviction investments, because we think those will generate stronger returns over the very long term. But of course, these concentrated portfolios can be very volatile in the short term. And we know that volatility is difficult for people, particularly when they're trying to hold things for long periods like generations. You've seen very recently in the market that there's some very high profile funds that have had exceptionally strong performance and then exceptionally weak performance. And that just creates a lot of difficulty for people. We're all human, we all react to that. And not everyone gets things right all of the time. It's not possible. So our approach is to have these high conviction portfolios, but our risk control is to have lots of them combined together. So we have about 10 stock pickers, all throwing in their best ideas. And it's that diversity of idea generation that gives the portfolio greater stability, greater diversity, and enables it to sort of keep plowing on and hopefully outperforming through different market environments over the long term. So it should give you a more stable return profile than an individual manager, but hopefully as strong returns in the long run. So that's in a nutshell the main portfolio structure. The next pillar is just very quickly exclusive access. Willis Towers Watson's a global organization. We've got research all around the world. We're trying to bring some of the best managers around the world to the UK retail audience. So some of them you probably don't know or can't access. Some of them you can, but even those that you can't access their customized, concentrated portfolio that we have in Alliance Trust. Then there's dividend growth. So whilst we're trying to maximize long-term returns, we do it through both capital growth and a rising dividend. And Alliance Trust is very proud of its history of growing that dividend every year for the last 55 years. And if you've been watching closely, we also had a step increase in that level of dividend quite recently. It's quite a significant increase in that dividend overall. But key to this is maintaining the growth of that dividend over time. And of course, when you're doing anything in equities and thinking about long-term equity investing, sustainability is very important nowadays. So whilst we try to present this as a best-in-class offering, we're also, we think, offering a best-in-class integrated sustainability solution where we completely understand, acknowledge, and analyze all of the ESG issues when we're picking companies. And when we own companies, we try to act in the right way. We try to vote and engage with companies to make sure that they are aligned with either net zero goals for 2050 or other sort of ESG sustainable goals that people have. So all of that is sort of what we bring through Alliance Trust, and we try to deliver the whole package, if you like, at a low cost. We know a lot of the failures of multi-managers is just layering on too much cost and making it far too expensive overall. We use our brand, our scale, our global reach to sort of drive down costs and therefore deliver the whole trust at an ongoing charges ratio of about 0.6%, which we think is pretty reasonable for a highly active, high conviction global equity strategy.
There's a question here, Stuart. Why is it that you saying sort of 20 stocks? Why not 10 stocks? What's the rationale of having 20?
Yeah, so we say up to 20. Somewhere between 10 and 20 is where most of the managers generally are. So I think the reason we say up to 20 is because we have to have some level of diversity in individual stock pickers' portfolios. No one can choose the one best stock in the market and get it right. You need some diversity in their idea generation, and somewhere between 10 and 20 is the right balance between having very high conviction ideas that will drive returns, but enough diversity such that if they get one idea wrong, it's not the total end of the portfolio.
Okay, thank you.
Good. So I've got a couple of slides here just on market context, and this is very high level. I'm sure we'll get into more detail with questions. But since we started managing the portfolio in 2017, this is what's been driving returns in the markets across these broad factor drivers. So sectors, size of companies, regions, and styles. And what's very obvious, and I'm sure people are aware, is technology companies have just dominated through this whole period. It's been large cap companies outperforming mid and small. And you can see from the regions chart that the US has just outperformed every other major region by a pretty big margin. So US large cap tech companies, these growth businesses, have just dominated for quite a long period of time now. And I think everyone's pretty aware of that. The next slide just shows year to date. And really we're just trying to show that this can change. So obviously energy is now very dominant, and I think everyone knows the reasons why. Large caps still outperforming actually, but you can see a change in the region, and certainly from a style perspective, value has been outperforming growth, and that's really about energy outperforming technology for a change. And I think maybe we'll get into this in Q&A, but clearly the market has been flip-flopping between a lot of very high-level macro drivers recently, be it COVID, stimulus, vaccine recovery periods, inflation, interest rates, or then peak inflation, or worries about recession. There's been all sorts of things where the market just switches direction and trades these big macro ideas. So it's not been an environment where people have been focusing on company fundamentals, but it is company fundamentals which really drive share prices in the long run. So the next slide, slide 5, just shows how have we at Alliance Trust been doing through this period, because we are focused on company fundamentals, because we do think they drive returns in the long run. So there's a lot of numbers on this page. We've got total shareholder returns at the top, and we've got the NAV total return below that. The bold line is the NAV return excluding non-core assets. Very simply, that's in bold because we think it's the most useful thing to look at right now, because when we took over the portfolio in 2017, it was about 90% equities and 10% other assets, some private equity, the savings platform subsidiary, some mineral rights, etc. And those assets were gradually sold off over the next couple of years. So this NAV return excluding those non-core assets is the best representation of the equity portfolio that we're running today. And then you've got the benchmark MSCI ACWI absolute return below that. So I think the first thing to say here is that if you look since inception of our management of the company, 9% per annum return, pretty decent absolute return, but slightly behind that of the benchmark. So that is clearly not where we expect to be. Long term, we expect this high conviction, diversified strategy to outperform the market, the benchmark in the very long term through good stock selection. And like I said, stock selection has been pretty tough in the last few years because of some of the macro events that we'll talk about in a lot more detail. But the table below it is just showing a variety of other comparators. So for example, the MSCI ACWI benchmark, but equally weighted. So exactly the same stocks, but now equally weighted instead of market cap weighted. And that is a lot more like, it's a lot more of a better comparative, if you like, for what we're asking the managers to do, which is, there's all these companies in the world, please pick the best ones that will outperform the most. And you can see that they've actually outperformed that quite significantly over this period. And also you can see versus the global sector average or peer groups, you know, the stock picking and the performance of the strategy has actually been reasonably decent against a variety of comparators. But of course, the benchmark itself has been very dominated by these large cap tech stocks, which have done very well. So we are behind the benchmark over that 5+ year period. But we think the strategy has actually been delivering reasonably well, all things considered, given the environment that we've been through. And clearly, we're very, very optimistic about the outlook of the portfolio from here. But I'm just going to pause at this point because I'm sure there's plenty of questions which will get us into a discussion on that as we go.
Cool. Okay. Let's start with one in terms of the sort of structure of the fund. Does every single manager get the same percentage of the fund to run?
They don't. So in principle, we think all of these managers are skilled at what they do, and we start off with a fairly equal allocation in mind. But we actually adjust those allocations to help manage the total portfolio exposure. So we've got a slide on, if you jump to slide 9, we've got a little pie chart showing what the allocations are. So they're not, you can see that they're not equally weighted, but you know, there's a pretty even distribution. So what we want to make sure is that they're all contributing reasonably evenly in terms of risk to the portfolio. And we as Willis Towers Watson will be changing these allocations to make sure that the total fund structure has the right risk profile overall, you know, given the environment that we happen to find ourselves in. So Willis Towers Watson will be constantly trying to adjust these weightings to make sure that the total fund makes sense. I can go into that in more detail if you like.
Sure, but you're picking between different managers. You're not trying to influence the position of the fund relative to factors, something like, you know, what you think is going to happen to inflation, for example, are you?
So you're right that we're not picking the stocks. You know, we definitely are delegating the stock selection to the managers because that's the skill set that they have. But when we combine the total portfolio together, you know, we are thinking about some of those bigger picture risks, you know, like inflation, interest rates, and thinking about, you know, what those risks might do to the market in terms of, you know, the balance between value and growth stocks and where valuations are today. And we will be adjusting the portfolio to make sure that we're not taking big risks on those macro drivers, because the goal here is to make sure that the stock selection is driving our returns. Frankly, we don't think we or anyone really has got a very strong ability to forecast, you know, what is inflation interest rates going to do to equity valuations in the near term. So we're adjusting these weights to try and make sure that we're not taking that sort of risk, rather than trying to put our view into the portfolio, if you see what I mean.
Yeah, that makes sense. So do you try and balance the portfolio between sort of growth and value, for example?
Yeah, that's right. So if we look at the next slide, this is, you know, at a very high level, the shape of the portfolio at a, you know, combined level. So you've got sectors on the left, geography in the middle, and we've got style tilts relative to the market on the right. You know, this style chart, for example, it basically shows that these tilts are pretty close to zero. And you can think of them as like standard deviations. So, you know, something close to zero basically means we're not taking a big deviation on value stocks or growth stocks or quality stocks. And the reason for that is, you know, it's quite simple, but quite important actually, because over the very, very long term, value and growth tend to do about the same. But over short periods, and I say short could even be sort of 5-10 years, you know, you can have massive deviations. So ultimately, picking value versus growth over generations, which is how we think about this, should probably yield about nothing in terms of active return. but it does give you lots and lots of risk. So that's not something that we think is a great strategy. Like trying to pick, will value or growth outperform next year or not? Again, we don't think anyone really has the skill set of doing that. So we're trying not to take that risk in the portfolio. And that's exactly why we keep value and growth tilts pretty stable and pretty similar to the market overall. So we're not taking those risks. And the last thing I'll point out on this slide is just that active money in the top right corner. Active money is really high. So this is a very highly active portfolio. But where is that risk coming from? It's coming from stock selection. It's not coming from a bet on value versus growth or a bet on tech versus energy, for example.
Okay, that makes sense. Does that mean you end up with a beta of about 1?
Yep, that's right. Again, not precisely 1. You can never be too precise about these things, but around 1 most of the time, yes.
Okay. How liquid are the individual portfolios? Does there's a sort of bias to small cap within them?
Yeah, so the portfolio is very liquid overall. Obviously it's a closed-end portfolio, but we could liquidate the whole portfolio very quickly if we needed to, which of course should never really happen. But the liquidity is very high and not an issue. But you are right that overall the portfolio has a slight bias away from the very, very large caps, and that's purely because the index is incredibly skewed by size. It's almost exponential how you see the distribution of capital across the benchmark. You have these huge allocations to Apple, for example, and very, very small allocations to smaller companies. So that sort of uneven distribution of capital in the benchmark doesn't really make a great deal of sense to us. So our portfolio is a lot more balanced in how it distributes capital. We've got a more even we're not equally weighted, but a much more even level of distribution across our ideas. And what that ultimately means is we tend to have a slight bias away from the mega caps compared to the benchmark. But that does not mean that we're purely a small cap portfolio. We've actually got lots of very large companies in the portfolio, so liquidity is very high, but we're just not quite as skewed as the benchmark is. Okay,
that makes sense. In terms of the performance of the, I'm going the wrong way now. In terms of the performance of the individual managers, is there much dispersion?
There certainly is. That's an interesting question because, like I said, these are concentrated portfolios, so they are very volatile in the short term. And these managers have got completely different ideas and different ways of thinking about investing. So let's just pick some on this slide. The obvious ones I tend to use would be SGA, which is Sustainable Growth Advisors. For obvious reasons, they're looking for sustainable growth companies. So companies that are really high quality, high growth rates, and compounding those growth rates for long periods of time. These are really firing on all cylinders. And then you look at a manager like a Lyrical, say. Lyrical is looking for really cheap companies. They're just going to the bottom decile of cheapness. A lot of those companies are cheap for a reason, by the way. There's problems with these businesses. The market doesn't like them for some reason. Lyrical is trying to pick out the ones that are actually genuinely really good companies, but are just mispriced or misunderstood at this point of time. But you can see that these are completely different types of strategies. One's buying good quality, large cap growth businesses. Lyrical's buying smaller, very cheap, unloved types of companies. And of course, they perform incredibly differently. And your question about dispersion is really interesting because they will always have lots of dispersion between these managers. That's normal and expected. And frankly, that's what we want. But dispersion recently has exploded because we've seen such a bifurcation in markets between value versus growth, or when the market just decides it's going to go in one direction or another. The swings have been so big that it really is affecting the manager performance in a big way. So they're getting swung around by these big market forces, but ultimately the companies themselves are much more stable than their share prices would actually suggest.
Okay. There's a very specific question about GQG. Do the question is saying, what do you think about the recent outperformance of GQG? Is this a case of style drift? Maybe you can explain the context of that, please.
Yeah, I understand that very well. It's a really good question. So let's jump to slide 11, maybe. This is not necessarily the best way of explaining it, but GQG stands for Global Quality Growth. So again, yeah, thanks. So quality growth companies is what they're after, large cap quality growth companies. Everyone thinks that has a certain definition. Now, GQG is a bit more flexible about how they think about what is quality. So for many years, they would have owned a lot of these large cap tech companies. You know, they would have talked about things like Adobe being really quite critical to a business. You know, how does a business turn off Adobe? It's some of these tech things are so embedded in management of the company nowadays that they're actually really high quality and durable companies. But about a year or 18 months ago, you know, GQG reached the conclusion that yes, these are great businesses, but they are getting very, very expensive. And you know, they were looking at other parts of the market, like the energy space, for example, and some of the mining material companies, and saying actually, the cash flows that these companies are able to generate now are, have got long duration. They are good quality cash flows that we have confidence in over the long period of time, and they're now incredibly cheap. So he started rotating his portfolio. He was probably about 40% tech, I think, and moved more towards 30–40% energy at one point. So a big change. Now, some people see that as style drift. Because we understand how GQG think and how they operate, I see consistent application of their philosophy, but they've changed the portfolio structure because the portfolios that fit what they're looking for has changed given market pricing. So we actually think this is completely consistent with how they invest their capital, but the characteristics of the portfolio have changed a lot. Now, of course, it's been incredibly beneficial for their performance as well. Obviously, moving from tech to energy about a year or so ago has paid off in a very big way. And of course, you can see Petrobras on this slide has now become a very large position in the portfolio. It's one of our largest contributors to performance over that period. So it's definitely been the right thing to do. I don't call it style drift. I think if a lot of managers did this, I think it would be style drift and you'd have a lot of questions. But this does fit with our understanding of how GQG evolves their portfolio over time. So we think it's consistent.
Thank you. That makes sense. So taking a step back again, how do you go about choosing managers? And maybe you could sort of illustrate it by talking about the most recent addition to the portfolio and why you decided they fit the criteria to be included in the fund.
Yeah, sure. I don't have a slide on this, unfortunately, but maybe we'll just jump back to slide 9, which has got the managers on it. So our strategy for selecting managers is, is very detailed. Like I said, we've got a large global research team who spends, all of their time just researching equity managers. So we're meeting thousands of managers around the world, and you really got to try and differentiate between, who are doing things in a different way and doing something genuinely, high quality, interesting, differentiated that can lead them to outperform. Because we know that most managers underperform net of fees over the long run. Picking managers is not an easy thing to do. So just looking at their track records, unfortunately, isn't enough. And I know a lot of people spend their time looking at track records because that's the information that people have available. But we spend our time not only looking at those track records, but spending hundreds of hours talking to the managers about their research processes, about their stock analysis, about their portfolio construction decisioning, about their risk management, just going through all of their decision making and their research and trying to differentiate who is actually doing something better than others. So that's how we understand who's got a competitive advantage in picking stocks. The second part of what we do is really about the culture of the business and the environment they're sitting, because we know that picking stocks and making investment decisions about the future is really hard, and making good long-term decisions is not easy to do if you're in a chaotic environment that's focused on short-term stuff. So we do focus on the culture of the businesses, the alignments of interest between investors, managers, the business itself. We want to see stability, long-term stability. So in terms of an example, I think Metropolis and Sands were the two most recent managers included in the portfolio. Metropolis has got it's got the biggest weight there. Let's do Metropolis. So Metropolis is a privately owned firm. It was set up some years ago now, probably 15 years ago, by two individuals who have a real passion for investing. So long story short, this private ownership structure, the investment-led culture, the longevity in which the stability of the business and how it's been created gives all of the ticks a lot of our boxes, if you like, in terms of the stability and the culture of the organization. When we're talking, it's only a small firm. So when we're talking about how do you have a competitive advantage in picking companies, it's not because they're bigger or have more data than anyone else. They have access to data, same as everyone. It's really in how they process it and how they make judgments. Their background, the PMs here, was in private equity, and they worked at Bain as well, also in sort of company analysis. So their background is very different from people who just purely come into buy-side research. And I think that sort of ownership mentality and sort of business operator mentality gives them a differentiated insight into how to think about the companies and their valuations. So that's just one example of how we go through the research approach, how they make their decisions, and how we think they're differentiated versus other people. So maybe I'll just stop there. And
then, so who did they replace, and why did you take that manager out?
Yeah, excellent. So we took River and Mercantile out of the portfolio, I think back in February, March of this year. So River and Merc was a fairly deep value orientated manager. I think a lot of your listeners will probably know Hugh Sargent. We've known him a very long time. I think he's a great investor. But the business went through a lot of change. So it has part of the business which is really on solutions, investor solutions. That was sold to Schroders, and the remaining business was effectively sold. The remaining asset management business was sold as well. So you've seen a significant change in the ownership structure, the management structure. We think a big change in the culture of the organization, and we were concerned, frankly, not because Hugh Sargent had changed or his team had changed dramatically, but that disruption of the business we don't think was a good environment for them to sit in for the long term. So that's why we decided to remove them from the portfolio. And then that's why we brought in Metropolis, for example. So Metropolis is also a value manager. So we're not saying they're exactly like for like, but it has value characteristics, which when we're trying to blend a portfolio of managers who think differently to each other, you've lost a value manager, we're now putting in a value manager. And then we sort of reallocate the portfolio a little bit to make sure that the total portfolio exposures still make sense, having made this manager change.
Okay.
Yeah.
So how many stocks are there in the portfolio altogether?
There's about 200 or so, 150 to 200 would be typical, I think. It's changed a little bit because GQG, as well as their up to 20 stock global portfolio, we asked GQG to run an emerging market sleeve as well, which is why their weight's a bit higher here, actually. So they've probably got about 5-6% in emerging markets. And that can tend to have a few more stocks in it. So it's more like 30 to 50 stocks in EM, just because EM is a little bit different in some senses. So that's why it's probably more towards the 200 end right now rather than 150.
If they're all best ideas fund, does that mean there's fairly low turnover on the underlying portfolio?
Yeah, we think so. People have got different ideas about what low turnover means, but yes, these managers are all thinking about 5-10 year time horizons when thinking about companies. So holding periods should be long. Now, of course, when markets are volatile, that leads to changes in prices and therefore changes in portfolio. So it's not that we're taking short-term views of the companies, but when prices change really quickly, we see more turnover. But I would say turnover has been averaging around, let's say around 50% roughly on average since inception. Some of that, of course, is Willis Towers Watson either changing managers or reallocating a bit of capital between managers. So the managers themselves, their stock turnover is a bit lower than that. So yeah, we think fairly low turnover overall, long-term mindset.
Okay. Looking at the portfolio here, the question was, to what degree is there an overlap amongst the managers? And I suppose we can see here that Visa is actually held by 5 of them. Is that something that concerns you, or is that just sort of reinforces the idea this must be a really good stocking idea? Yeah,
so we get this question all the time. Like, what happens if all the managers just buy the same stuff? So hopefully, we described earlier the example of 2 managers who just think completely differently. Most of the time, the chances of them buying the same company are very, very low. So we've got 12 stocks on this page. 2 of them are stocks that we don't own at all, so Apple and Tesla. The other top 10 that we own, you can see that in the top 10 active positions, 4 of them are only owned by 1 manager, so there's no overlap. So even right at the top of the portfolio, you're not seeing a huge amount of overlap. But then there are, the Visas and the Alphabets of the world, where we've got quite a few stock pickers all thinking it's a good idea, and actually it's stock pickers with different perspectives. So value, quality, growth managers, different ones will own it. So we don't want to get carried away with this idea that if everyone loves it, it must be really good and we should put lots of capital into it, because I think that would not be great risk management overall. We still want a high conviction but diverse portfolio, so we want diversity of ideas. We don't want to put all our eggs into this one basket. So I think if we saw Visa, the position size in the portfolio, getting too big, we would do something about that, as in take capital away from some of the managers that own Visa, for example. But as you can see, the position sizes here are all pretty reasonable. Nothing's getting too out of line. But of course, like I said, if Visa just started getting far too big from a risk perspective, we would adjust the portfolio. But the overlap has never been an issue, simply because we are picking managers that think very differently, and therefore the overlaps generally have been very low.
Okay. How does the cash position and the gearing work? What's sort of thinking that drives that?
Yeah, so the managers actually tend to hold a little bit of cash in the portfolio. I mean, that's partly just because these are very concentrated portfolios. So sometimes they want to act quite quickly when an opportunity arises. Sometimes it's helpful for them to have a little bit of cash to invest before they have to start selling something that they already own. So let's say 2% might be a typical amount of cash in the portfolio that they might have on average. And we're comfortable with that. I think the gearing discussion is slightly separate to that, in the sense that we're not, like I said, we're trying to drive returns through stock selection, and at the same time as not trying to make big calls on inflation, interest rates, and macro drivers. We're not trying to make big heroic calls with the gearing. We've actually got a slide, I think. Oh no, we don't on gearing. No, we don't. Sorry. So our gearing should typically be about 10%. That's what we've agreed with the board that 10% would be the average level of gearing through time. Clearly, we have some flexibility to move around that. So as of today, for example, our gearing is around 8%. That's gross gearing, gross of that cash. And that sort of reflects the fact that we are still slightly cautious about the outlook at this point. Whilst we're not trying to make big forecasts, we do see risks probably skewed a bit more to the downside than the upside at this point. So gearing has been a bit lower for most of this year, actually, which has clearly been beneficial given market movements. But so we're at 8% rather than 10, which, to give you an idea, that's how we manage the gearing. We're not trying to make big moves, but we do adjust it to reflect market environments. And of course, if markets were to fall further, we'd probably be adding to that gearing and bringing it back up again. But maybe sort of 7.5, 12.5 might be a typical range around the center of 10.
If you got worried that markets were looking toppy, would you use any kind of derivative position to manage the risk?
So it's possible, and you say never, but that's not what I would expect to do. No. Again, trying to make big market calls at extremes. If you get it right, you're heroic, but if it goes wrong, it can be really, really quite painful. So again, we're really just trying to take long-term views, this sort of generational compounding of wealth mindset. The diversity of the portfolio and the strong fundamentals of the business is really what gets us through the long term. We're not completely immune to volatility. I think it's almost impossible to be completely immune to volatility, but that diversity and good quality fundamentals should hold us in better stead than most of our peers, I would say.
Do the individual managers get to choose how much market exposure they have, or are they supposed to be fully invested the whole time?
No, our mandate to them is to be fully invested. Basically, it's you can look across the whole world, pick the 20, up to 20 best ideas. If they can't find 20 companies that look attractive at any point in time, then I think that's more of a serious concern. So we expect them to be fully invested, find best ideas.
There's an interesting question here. Was kind of a statement really, but could you see? Do you agree that sometimes the best ideas could be short ideas?
That's an interesting question. So yes, I mean clearly that is possible. I think long short strategies are very different to running long only strategies. I think the skill sets required are not the same. So we at Willis Towers Watson, we're running equity portfolios here. We also have expertise in hedge funds, private market portfolios, and all sorts of other asset classes. We're a multi-asset organization, so we're very comfortable with the idea of looking at shorts, for example. But I wouldn't want our long only managers to start shorting stocks. I think it's a very, very different risk profile. It's a very, very different skill set. And I think that's not what Alliance Trust shareholders are looking for us to do. Again, this Alliance Trust is just a global equity long only portfolio looking to compound wealth over long periods of time, recognizing that equities do go up over long periods of time, but with some volatility. So we're not a short-term market timing vehicle. It's a long-term wealth compounding vehicle.
Okay, thank you. In terms of volatility of return, are you less volatile than the index?
Well, it's an interesting one. Like you said earlier, we tend to have an equity beta around 1. We are a fairly fully invested global equity portfolio, slightly leveraged, of course, as we've just been talking about. So volatility tends to be around the same as the market. We do think that actually our companies are stronger fundamentally, and we've actually got a slide to talk a bit about that if we'd like to go to it. But that fundamental strength should hold us in better stead in the long run. But the market prices move as the market determines. So our volatility tends to be about the same as the market, roughly speaking, overall. Fair
enough. Actually, I wanted to just touch on this slide before we finish, because there's quite a big jump in the dividend this year or last year. What drove that?
Yeah, so I think this was really driven by the board and their sort of discussions on what our shareholders are wanting from Alliance Trust, and also taking advantage of Alliance Trust scale and strength in terms of reserves and overall scale and assets. So whilst we've grown that dividend every year for 55 years, the level of the dividend wasn't incredibly high, and it was thought that a lot of investors actually would appreciate a higher level of dividend as well as the dividend growth. And given that Alliance Trust has the scale and resources to be able to offer that, the board took the decision that they would make that sort of step increase, if you like, in the dividend. So it was a pretty big jump, as he said, about over 30% increase in that dividend. So significant rise, but again, only done with the knowledge that they can continue to grow that dividend year on year going forward, because that sort of long history of growing the dividend is of paramount importance to the board.
Okay,
so,
thank you.
Yeah,
that makes sense. Obviously, that's something that I think investors are going to be looking for over the next couple of years as we go to more difficult times. Just to sort of sum up, what do you think? There's a bit by chart there. What do you think is the sort of outlook for the markets and the fund over the coming year?
Yeah, it's clearly there's a lot of uncertainty, and I won't profess to knowing what's going to happen, of course. But maybe slide 8 might be useful here, because I think the best I can really do is bring this back to the context of what Alliance Trust is doing. So what's our outlook for our portfolio? Now, obviously, there's going to be challenges that everyone's well aware of. People are concerned about inflation. Inflation was thought to be transitory, but it seems like it's going to be higher or for longer than expected. Interest rates are going to go up. They're probably going to be higher than people expected for a while longer. People are worried about recession. There's lots of things to be concerned about, but these are fairly well-known things at this point. I think the thing that gives us confidence is, the chart on the left here is really showing how have the returns of the Alliance Trust portfolio and the benchmark been generated. So as I mentioned, we are slightly behind the benchmark. So if you look at the total bars, we're actually slightly behind the benchmark over a 5-year period, say. But if we look at how those returns have been generated, the Alliance Trust portfolio has fundamentally grown the value of its businesses better over time than the benchmark has. So we've seen more growth in the fundamental value of the companies, and we've seen less multiple expansion. So the benchmark has basically benefited more from people being willing to pay more money for the same fundamental value of a business. And what the chart on the right is showing is that over very, very long periods of time, share prices follow fundamentals, because when companies grow their revenues, sales, cash flows, earnings, when those things grow over time, share prices grow over time. So this is sort of what I mean by the companies in the Alliance Trust portfolio are very fundamentally strong and very well positioned versus the benchmark. So whilst it's been a pretty tough environment in the last few years for focusing on company fundamentals, because the market's been so macro driven, this is why we're so excited about the position today, because it's created this opportunity for stock pickers, because you can buy companies that are fundamentally stronger, that will set us up for future outperformance of the market in our view going forward. So whilst there's a lot of uncertainty in the world today, and clearly we don't try and make huge forecasts about where the market's going, what we do know is that our portfolio is well positioned, our companies are very strong, and our stock pickers are executing their processes very well and picking really interesting investments for long-term compounding of wealth. So our outlook from here for our portfolio is, in our view, very attractive compared to the market.
Great, thank you, Stuart. That sounds encouraging. So we'd point out that you've been, I think, the second best performing fund year to date in the global sector by quite some margin. Actually, it's interesting how badly most of the others have done. So long may it continue.
Well, yeah, exactly. It is. I mean, I think, and that reflects a little bit the fact that individual managers have volatile performance, and if you're reliant on a certain style for investing, it can work very well or it can work very badly. And I think the benefits of having this diversity in the Alliance Trust portfolio is really starting to be shown right now. So that's very encouraging. And it might also show just how tilted the peer group in the universe has been towards growth investing, perhaps. Who knows?
Thank you very much. We should wrap it up there. It's now 12 o'clock. I think it's important to just let people read the important information slides, but there we go. Thank you. So we obviously will be back next week. And as I mentioned earlier, we'll be talking to the manager of Bearing Emerging EMEA Opportunities, who I think we talked to before on the show, but there's obviously been an awful lot going on in terms of that portfolio as it's had to deal with the fallout of Russian sanctions and things. And as I think I mentioned earlier, that Gulf has actually done particularly well. That's an area that Bearing Emerging should have some exposure to. Then the week after, it's straight to Japan, and then Richard will be talking to the manager of Life Science REIT. We've still got an empty slot on the 14th, but we will fill that up shortly, I think. And we are prepping for our conferences, so I'll tell you more about those when we have some more information. So in the meantime, have a good week. We obviously will be closer to this on Monday, but otherwise we'll be back next Friday. Thanks very much.